Good afternoon, everybody. So it feels like we had a lot of pessimism earlier in the day, fully justified, but still pessimism and misery. So I'm going to try and say some positive things. So please bear with me. I wasn't originally planning to be quite so positive, but given how the morning started, it feels like we need a bit of positivity. So I'm going to talk about real estate debt in an inflationary world. As we know, there are a lot of headwinds. For us as a lender, it's a time to be risk averse. But I think there's a lot of optimism that we can look at when it comes to real estate debt as an asset class versus other asset classes in an inflationary world. So I'm going to focus on the opportunities, but what I will just say is that as an asset manager, it really is time to focus on asset quality and sponsor quality. Credit metrics are not going to be enough. Successful lending really will be about picking the right asset, the right business plan, and the right sponsor. So, flicking to the optimistic slides. So why is the industry well set? As we can see, in the last 12 to 14 years, LTVs have gradually come down, which means that as an industry, we have a lot better downside protection than we might have had previously. In addition, when we look at all of the money raised for European real estate debt, the vast majority is for funds which have a lot of senior loans in them. That means we have a lot more control over what happens to the loans and the assets if things start to go well. So as an industry, we're in a relatively better position. So what are the benefits of real estate debt in an inflationary world? You can see your inflation versus 5-year Euribor. 5-year Euribor is the market's expectation of what reference rates will be over a 5-year period. The market generally expects central banks to react to inflation by increasing rates. Therefore, as you'd expect, 5-year Euribor roughly tracks inflation over history. For floating rate lenders, that means that total coupons are increasing, and therefore you're looking at an asset class which provides a good level of inflation protection. In addition, real estate debt is obviously secured on real estate, and real estate itself typically outperforms versus other asset classes in times of inflation. And thirdly, for an active portfolio of medium-term loans, the underlying collateral churns every 3 to 5 years. So you're looking at a portfolio that is secured on real estate which is rebased to market, where rents and values are rebased to market on a regular basis. So we have an asset class which provides inflation protection, which is secured on collateral, which is well inflation protected, and where the collateral is churned and rebased to market on a regular basis. So what are some of the